The boroughs are New York City. The burbs are everywhere else. Real estate is the ultimate game of risk and reward. It's the biggest investment most people ever make. Fortunes are made over a lifetime and lost in a day. And we're not playing with monopoly money. How do you stay ahead? Who's buying? Who's selling? And why? What do they know? We want the truth. You need an edge. Boroughs and Burbs is your secret weapon, giving you the insider knowledge and strategies you need to succeed in the high-stakes world of real estate. From Palm Beach to Palm Springs, Manhattan to Malibu, we press the experts to expose the pain, find the deals, and occasionally predict the future. That's Boroughs and Burbs, Thursdays, 3 o'clock Eastern, noon Pacific. Because everyone can make money in real estate.
Welcome, everybody. Boroughs and Burbs, number 166. This week, we're doing the year-end market report. Oh, man, I just lost my screen. Where'd it go? Boom. There we go. I want to begin by thanking Grace Farms. There it is, beautiful in the snow. We had some snow in New Canaan this week. That's what it looks like. And I want to bring your attention to the 2025 Design for Freedom Summit coming up at March 27th from 10 to 6. So put it on your calendar and come join me at the Design for Freedom Summit at Grace Farms. With that, I'm your host. I'm John Engel, that guy in the middle there with the bow tie, part of the Engel team out here in Connecticut. There's my co-host. Go ahead, say it.
I'm Roberto Cabrera with Brown Hair Stevens in Manhattan. And if I may introduce Jonathan Miller.
Yes.
I had an audio problem. Thank you so much for being here.
Oh, my pleasure.
You are our favorite and most reliable guest.
That's good to know. That just means I'm a good punching bag for you and John.
Who's that guy on Saturday Night Live who's hosted 17 times?
Alec Baldwin.
He's the Alec Baldwin of
right.
Boroughs and Burbs.
Yes, he is. Love it.
Yeah, there's so many jokes, so many directions I could go with that, but I choose not to.
So this is a good time to, year-end market report is all about, well, first of all, why don't you introduce him properly, right?
Yes.
Share. Let me hit share and we'll go right to, boom. Who is Jonathan Miller? Does anybody not know? He's got Miller Samuel, Real Estate Appraisers and Consultants. That's his main line of work. That's his bio, Miller Samuel. And I love him because he's got this housing notes that comes out every day now at 2 o'clock and is a must read if you want to understand housing sentiment, what rates are doing, and how it's going to affect the real estate market. So with that.
Thanks. Yeah, actually, the housing notes I've been writing for about a decade. And then in the summer, I pivoted to a more frequent single topic format. The prior version was sort of a dump truck where everything housing related the week was dumped into the Friday Post. And after doing that for almost 10 years, I thought, let's focus on specifically more on topics. And that's been the fun part. I'm trying to deliver, just like you are, trying to deliver information about the housing market to bring a little bit more transparency.
It's really great. And it must be tremendously demanding.
It is that thing where you've got to write it, and you have to be inspired, and it's usually not the obvious thing. Although I have to tell you, today I've gotten a lot of media calls about the wildfires in California, and I think I'm going to attempt to write something about that tomorrow. It's not about the impact. It's too soon to know the impact of anything, in terms of activity and prices. But I'm pretty confident I know what's going to happen. But it's more about insurance and the challenge of coverage. There's areas of California that just don't have wildfire insurance. You can't get it in Malibu.
What does that do to a real estate prices in an area that's affected? What does what has Florida taught us about lack of insurance on real estate prices?
Well, I tell you, the first time I was personally sort of connected to a climate event was Superstorm Sandy back in 2012 in New York, and the South Shore of Long Island, and then Queens and Brooklyn, were submerged and had a lot of damage. And what happened was middle class housing was sort of wiped off its foundations, and then it was replaced with luxury or higher end housing, right? And that's what I've seen in all these events, is that the new product coming in tends to skew higher end because they can pay for the higher.
Jonathan, are you saying that the slums of Malibu are going to be replaced with high-end development?
Well, I tell
Really?
no, but it fares better. A higher end housing market is probably is probably more quickly recovered. And I had read about, there was a sale. I track as a hobby, as a Dell and Board numbers guy. I track the sales in the US 50 million or higher, and it's pretty widely covered at the end of each year. And the highest sale of the year was 195 million in Malibu. And what I had read is that house was unable to obtain insurance for wildfires. And you go, wow, you're risking 195 million, but really the value is in the land, the house itself. While many millions of dollars, it's very tiny in the context of 195 million dollars as a purchase price. And so that's why higher end markets, I'm not saying they're immune or anything, because they certainly will, and who knows what will happen, but at least in the short term, that they're less impacted in terms of replacement.
Has Florida, since we're already talking about hurricanes and weather and now wildfires?
I try to be positive, John. I try to be positive about everything I talk about. So,
have we seen this affect new building costs and commodity prices in the time immediately following? Are we going to see, for the first 6 months of 2025, increased labor costs, wood costs, roofing costs nationally as a result of California consuming a great deal of the resources?
Yeah, I would think so. In the first year or two. I mean, I had read somewhere in the LA situation that, like Malibu, it's going to take 10 years to replace. I don't know about that. 10 years to replace all the housing, but just think about if you're trying to replace 1,000 houses in a short period of time. Well, you're going to, the contractor that you would normally hire now has 20 jobs instead of 3. So it's going to take longer, be more expensive. And then the materials, the same thing. You have this sort of this higher need in this one local market. So, it's sort of twofold. I think nationally prices, it creates inflation for, construction materials and labor. But it's certainly more of an issue in the local market than it is national, but I think it impacts everybody. The thing is that every year we're having these events set new records, and the LA event is forecast to be like $50 billion, the highest in history.
I'm going to push back and say $50 billion is not enough to affect national real estate prices, is not enough to affect.
It's not national real estate prices.
It's a hurricane in Florida, and they have to rebuild 1,000 homes in Sanibel. Do we even notice?
In terms of housing prices, no. I was saying it in terms of cost, construction materials. That's where I think the inflation pressure comes.
I would imagine the scarcity of labor is really the biggest factor.
Could even be a bigger issue, especially if there's an immigration policy adopted that's been talked about in the election. It's just going to make labor much more expensive for new construction, and that's inflationary. So that's sort of what the market's facing, on top of, the fact that mortgage rates don't look like they're going to be dramatically lower in 2025, or even significantly lower.
Yeah.
I want to go through speed dating round with Jonathan now. I'm going to say a topic, and I just want you to blurt out the first thought that comes to your mind. And we're going to race through 10 of these, and then we can go back and tackle them with some more depth, if you will.
I haven't speed dated in a long time because I've been married 40 years, so I'm going to be a
this
little
is
rusty.
you and me both. So it's
Okay.
going to be a speed round. Interest rates at the end of the year.
Lower.
Yeah, what? 6.3?
Yeah, low sixes. They're going to rise some more, and then probably, but that's, my crystal ball is held together with duct tape. I mean, really, who knows?
Salt tax changes. Yes or no?
A weak no. I don't know if that'll pass, but if it does, it'll be a shorter term extension. It would be my guess. Because the salt tax really drove the deficit way up. So I don't know if it's going to happen. Go ahead.
We pay you to be sure. Okay, we'll move on to something.
Well, I'm sure. No, but just to be clear, John, I'm sure that I'm not sure.
Okay, fair.
So I'm very confident that I'm not sure.
Okay, New York City price appreciation 2025. That's something you can be sure on.
I would say 0.
Well,
I can
Roberto
answer.
will
I
have
can give you a
something to
lot. I
say
know
about
speed
that.
round, but I give you color to that.
We'll come back to that for sure.
Okay, please do.
Next hot market nationally. Some people believe that the bloom is off the rose in some of these hot markets in Florida, maybe Texas. So they're looking to new hot markets. What's the new hot market? And I've read in USA Today that it was Hartford, Connecticut. So come on, let's get creative here.
I know, and last year was probably Detroit. What does hot mean? To me, they're looking at it like the potential for price appreciation. So that means that you're looking at, a very, weak market, and, all of a sudden it's going to pop and the percentages go up. But like I've said before, like you go from 1 to 2, that's 100% increase, but it's only an increase of 1. So I'm not a listicle fan. Fans of listicles.
I'm gonna help you out and prompt and say, how about the Carolinas? Anywhere in the Carolinas within 1 hour of an airport. Nice weather, and I can get there.
But is that new hot?
Well, good question. Tennessee.
I mean, a lot of people from my old town in Connecticut actually retired there. I mean, and that was like,
so it's 5, 7
years
to get in. We need something. We need a new hot market. Okay.
Right. I am not your guy for that stuff.
Okay.
Very cynical about hotness.
All right. My next question was next hot market for a second home, meaning are we excited about any of these locations after the hurricane season and now some of the others? I mean, have we got any place that people are starting to talk about next?
I don't feel informed about it, so I can't tell you. Sorry.
Okay.
I think the second home market was largely driven by rates being so low that people could afford 2 mortgages. And I'm not talking luxury, the Hamptons. I'm talking like New Hampshire, a modest, weekend place. I think that market is still pretty vulnerable, which means probably weaker pricing, which is an opportunity, I would think.
Well, vulnerable because people will be selling some of those?
Yeah, or no, actually it's more that the rates are, double or, 2.5 times what they were when it was booming.
Yeah.
So to be able to carry a second mortgage, a second first mortgage or whatever, a mortgage on your your vacation home is much more expensive now than it was 5 years ago.
Yeah.
And so I just think that that has more drag on those housing markets than it does on the primary housing markets. Secondary markets are always more vulnerable to higher rates.
My next one was New York neighborhood opportunity. Blurt something out.
Again, I have no opinion. I look at I have all kinds of data on neighborhoods. I
Right.
look at the
You've been
neighborhoods.
tracking the run up in Brooklyn for years, the
Oh
Queens
yeah,
waterfront, oh, uptown is hot. Oh, nope, it's downtown. So what are you
yeah.
excited about
It
in 2025?
it's funny. I'm not excited. Uh,
Oh, Mr.
and
Zero growth.
the reason why I say that is because that's not how I view housing. I don't think of it that way. Um, I think of it as every transaction is a unique opportunity, and it's a deal or it's not a deal. Um, but it isn't like, hey, Greenwich Village is a better deal than Tribeca. Like, I don't, my brain doesn't work that way. So I'm not trying to be difficult. That's just not what I do as an analyst. I don't think that way. I can
You
make a
heard
list for you. I just
you
don't
heard about
believe
this
it.
change called congestion pricing? Maybe it's
Yes.
any place that's not in the box.
Yes. Well, it's going to be interesting because congestion pricing, I can see it now. There's going to be all kinds of studies on the impact of housing prices and, parking. Yeah, I think it's me more about parking costs, like they're going to be at a super premium in the low 60s as people park and then jump
Here
on
I
the
park.
subway. Yeah. But I don't think it's going to have a material impact on the housing market in Manhattan, at least at this point. And the big thing is the MTA needs the money. Like, just because ridership is down by a quarter, it's been rising, but it's still
It's
below
that no
pre.
one pays. They all jump the stiles.
Right. Well,
I
so
mean, you
that is
sit
like,
there and watch for 5 minutes, and there is a measurable percentage of people who just walk over it. It's
oh, it's
wild.
crazy. But not only that, but like it's so important to the sort of the heartbeat of the city that and they have to maintain it whether you're riding it or not. And that's what this tax, it goes 100% goes to the MTA. um and I think that's a good thing in the big picture. It does make life more expensive for people that depend on cars, but the city is trying to do what London's done, just reduce cars in the congested areas. Improves the quality of life. So
There's a guy who had to come to my apartment today, and he came in from New Jersey, and he's like, congestion pricing is for real. And he was like, unless something else is going on. And I was like, well, it's Carter's, funeral, and a lot of people aren't going to work. And he was like,
oh, right,
I was like,
interesting.
maybe not. It's like, so the verdict is still out.
Before we leave that, because you said congestion pricing, I'm not hearing a sympathetic line from Roberto who says, listen, our problems are due to mismanagement, not collecting the fares. Whereas you say, hey, the public transportation is a good thing. We need to invest in it. So what is the mood of the average Manhattanite right now toward investing in making this investment? Are people negative on it?
uh the more vocal or negative, like, it's one of those things where there is, you see it on the news. But ultimately it's something that has to happen. You can also say, hey, it's mismanagement, you have to fix things or whatever. But the bottom line is, the subways, if you want the subways to run, you've got to spend money on them. They wear, everyday wear and tear. And if the funding is cut by 25%, you just don't turn off 25% of the subway system. It's sort of a fixed cost. At least that's my view. And that's what makes Manhattan specifically so awesome, is you can get around it like it's relatively inexpensive versus taking a cab. And the city is trying to dissuade cars for other reasons like pollution and quality. It's a big deal. I remember, this is maybe way off on a tangent, but I remember like 5 or 6 years ago, I was giving a speech in Shanghai, of all places. My wife and I, like on even days, half the cars could drive on the roads, and odd days, the other half of the cars could drive on the roads. And then, like one day a week they could all drive. And like the noticeable difference between like them all driving and half driving on the pollution was unbelievable, like incredible. And we you have cars running all over the place. That's so it's part of it's just change and getting used to change. But the city is certainly not getting cheaper to live in, for sure.
Next question. Impact of record Wall Street bonuses. Now, I've already seen that the average one of us has made a pile of money each of the last 2 years in the stock market, and some of that is translated into a robust real estate market. But in this area, we depend more so than most on the health of Wall Street. And
Yeah.
so what's
Yeah,
been
Fairfield
the
County and the
impact?
securities industry are, like joined at the hip, much like the Hamptons are.
So, Mr. 0% growth New York City, can you talk to me about the fact that why isn't New York benefiting from this? We got record
Well,
bonuses getting paid.
yeah, and record profits too, or near record profits. We won't know. I mean, that's the Johnson and Associates report that comes out every fall, but the New York City state controller is like the real numbers, and that comes out in March. And the expectation is Wall Street had a good year, so I don't disagree with anything you're saying. What has changed since the financial crisis is that the securities industry's comp has a low, I don't have the exact numbers, but it's a lower percentage of bonus relative to overall comp because of the regulatory overlay that occurred after the financial crisis, because there was so much moral hazard associated with, you make $3 an hour, but you get $5 million if the deal closes. That caused the financial crisis, essentially, or one of the big causes. So bonuses are high, but they're not necessarily a high percentage of compensation. I mean, they are relative to other industries. One way to think about Wall
cash
Street.
component of it shrunk.
Yes, and actually a lot of it is like bonuses are deferred, or they're not cash, they're given like options, and so it sort of dampens it in the immediate sense, but it's spread out over 3 to 5 years. The other thing that's really interesting is that when you think of Wall Street, the securities industry in just New York City, not the suburbs like you're talking about, it's 23% of the wages and only like 3 or 4% of the jobs, right? And every Wall Street job creates 2.5 private sector jobs. So it is huge for the city's economy, just like tech has sort of filled in and come in, is a big second.
But still second, right?
Yeah, oh yeah, still second. But still far above the rest of the private sector. But
I'm
tech is
shocked
growing.
that you're so bearish to call it zero. Come on,
Uh,
Roberto.
well, you're not letting me. You
Okay.
haven't asked me why.
Okay, why?
Okay, all right.
Painful. Someone's killing
Okay,
us with
so
pliers.
what it is if you look at, I wrote about this like a week ago or so, new development and luxury are seeing. So when you ask that question, you go, prices can be up. And I go, no. And in fact, in the fourth quarter, median price was down about 5%. And the reason is that if you look at luxury and new development pricing, It's up. It's up a lot. If you look at resales, down. Pricing is flat to declining. And
We had an
so,
election might have had something to do with that.
yes, but it's been that way for about 5 years.
But
Like,
this past fall was an anomaly from all the past presidential years because the market actually surged.
okay, but
with it.
you're talking about something different. You're talking about sales.
Yeah.
I'm talking about
I am.
prices. So if you talk about sales, sales are up. Sales are up in Manhattan and Brooklyn and in Queens, like, and that's
And
actually the
prices
big.
have to follow. Prices have to follow a surge in sales.
Right. It takes like 12 to 18 months. So two things are happening in the city that aren't happening or aren't happening the same way in like the sort of the generic sort of idea of the rest of the US housing market is that sales are rising, inventory is slipping, and so the pace of the market is going faster. There's a bigger performance difference in the high end, or don't even say the top 10%, the top half or third. Pricing is flat to rising. Pricing is flat to falling, below that sort of half of the market. And that's interest rate related, right? And you look at the upper half, the more money you make, or the more your net worth is, the higher the probability you're going to use a lot of cash in your purchase. And Wall Street or the financial markets are the playground of wealthier people. I mean, aside from like pension funds for retirement funds and whatever, but just in terms of the stock market is like this sub market of the economy. It's not the economy, but it tends to skew to the wealthy. And with it performing well, you have equity drawdowns for down payments or people paying all cash for properties much more easily than people that are more dependent on mortgage rates. And so I think the market right now is favoring higher end, subsets like luxury and new development, et cetera. And that's really the issue. So it, because the market is flat, isn't negative to Greenwich or Fairfield or Darien or New Canaan or whatever. It's like, I think what's more important to look at is just general sales activity, as a barometer, because like you said, prices are the caboose at the end of the train when trains had cabooses, right? It's not the leading indicator. Prices are the last thing. It tells you after it's already happened.
In the suburbs, and we'll ask Scott Bennett what's going on the North Fork in a second, but I'm going to tell you in Connecticut, too little inventory,
Yeah.
no end in sight, not building fast enough. You look at new housing starts, not very much in the last quarter, expected to rise. A lot of optimism out there. I'm going to say, on the one hand, you're saying that having a negative effect is inflation and high rates. But on the other hand, I'm telling you that high earnings, a robust Wall Street, record bonuses, and the back to work phenomenon will all help the New York City market.
Totally agree. I totally agree. I'm not.
Pent up demand.
Yeah, well, that's my big thing, is that it has now been 3 years since the Fed pivoted. Early 22, it's now early 25. And so people that were waiting for rates to fall, they've been waiting for 3 years, right? And that's why we're seeing an uptick nationally. Existing home sales are up, and new pending home sales are up. It's kind of weird. I don't know if I believe that's sustainable or not, but they're up, and they're up even though mortgage rates are not down, right? So I look at it as, that's people running out of patience that can afford to buy at higher rates with maybe this sort of idea in the back of their mind that they can refi out, a few years from now. Maybe not that strongest story that it was, back in the summer before, rates really started to rise.
Yeah, the expectations have bringing a whole point down this year is more like half a point.
Yeah, yeah, and probably in the back half of the year, if anything, because the just everything sort of feeding into the economy now seems inflationary. We were talking about what's happening in LA, the hurricanes in Florida, the tariff.
Trump is about to, throw all the dishes off the table. So there's a lot of unpredictability there too.
Right. And all that does is make people more, makes lenders more sort of it, even if the data isn't showing it yet, a little bit more concerned. But, I think, most economists
in New
think that
York
rates
City,
will fall by the end of the year.
2/3 of all deals are cash deals. In Palm Beach, it's up over 90%. In the wealthy markets, these are not
Yeah.
rate dependent people.
Miami, it's the same thing. Like Miami's like, 60%. Yeah. What's interesting is I was looking at this a while ago, like, so we're like in the fourth quarter, we were at 63% cash. The record was a couple of quarters ago at 68. The normal is 50. And so the last year and a half, it's been in the 60s, except for one quarter, it dipped just below. And I look at that. And then when you look at during the pandemic, when rates were at the floor, sub 3% for a 30-year conforming loan, the share of cash was like 43%. Like, because if who wouldn't get a mortgage at, 2.75, right? And then as rates went up, that kind of went away.
So I'm going to ask Scott Bennett, North Fork, Long Island. Are you seeing the great wealth transfer is continuing to take place and people are buying second homes out on the North Fork? Or what's the dynamic in a rural suburban market like the North Fork of Long Island?
Great question. So thank you for the question, and also Happy New Year, everybody. So what I can tell you is our market is probably 90% second home buyer. And it's either somebody who's tired of the Hamptons and just wants to have that not see and be seen type of atmosphere that's a lot less expensive. Or it could just be somebody who is looking for a second home, generally coming from the Gold Coast or Manhattan. And I will tell you that there was a lot of anxiety, I think, in the second half of last year with just with our, I would say, our middle buyer, meaning the 1.2 to 3 million. They were a little hesitant, and I think they were a little nervous about rates and the direction of the country was going in. So did not see a lot of trades in that sector. That what did trade well was the uber luxury market over 4 million. Those things, like, they were flying off the shelf at prices I've never seen. And some of them never even hit the market. And the other market that was really not affected by the higher rates that much is the under a million market, which could still be a cash buyer. But there's just like getting onto the North Fork for under a million is like, wow, there's still a lot of pent up demand for that. And we don't have the inventory.
Yep.
So really interesting. And I just read the fourth quarter report that you sent out, Jonathan, before the call. Really interested to see what's happening in Manhattan. I'm not really shocked, but I can't believe that market is not falling apart a little bit more just because of what's happening in there and the lawlessness and just the lack of leadership.
Yeah, I think I think New York City needs a new PR agency because I don't know if I've ever said this story before, but I remember walking down Fifth Avenue on a sunny, beautiful day. Children are carrying their, walking, or moms are pushing strollers, dads are pushing strollers, walking dogs. I'm walking down Fifth Avenue on my way to my office, And my brother-in-law in Michigan, who's sitting on a couch and retired, he asked me how I was doing, and I said, I'm walking down Fifth Avenue. And he said, oh my God, you need to have a gun on both hips. It is the Wild West. And I go, what are you talking about? What are you talking about? I have appraisers that go all over the city. They don't feel unsafe. They've never, been almost mugged. It's like kind of bizarre. And so the perception of the city is not safe. And I'm not saying it's perfect and there aren't issues, but it is interesting, how much the perception plays a role, which that is value, right? Perception is value. So
Jonathan
it
Miller
is.
says it's safer than the headlines suggest.
Oh, absolutely.
All right,
Absolutely.
then.
You might be on the phone with somebody and an ambulance goes by and people are like, what's going on there?
Or you can
Right.
hear a bullet come through my window or something. No, it's not like that. But that's the perception. And this is somebody who I moved into in the city in like the mid 90s. And we had the highest crime rates ever. Like my dad coming to my office was mugged twice in broad daylight. People defecating on Fifth Avenue on the sidewalk, going into the East Village in piles of rubble, 3 out of every 4 lots. Like it is not that at all. So it's probably degraded somewhat because of the pandemic. But when you compare that to what it was in the 30 years ago, it's night and day. It's not like Fort Apache, the Bronx, that Paul Newman movie. That's like the stereotype of what the city is now. It's not like that at all. I'm telling you, the city needs new PR, but that's just me.
I agree with that. I do.
So I want to get to Roberto and find out whether he shares your pessimism that New York City is in for one more year of stagnation, or are you seeing price appreciation? And I want to tie that in with what you just referenced, which was the latest article, which is consumer sentiment and consumer confidence are both up. So if I ask most agents, they're all feeling good about the New York market, which is why I'm having a tough time with 0% growth.
Well-
I think that the market is just like it's pent up demand. People, it's that old analogy I make of like, there's a huge snowstorm outside and you sit there for a while. And after a while, you realize the snow, you got to move on with your life and you have to get out there and start doing it. And I think people are really I think the demand is really there. And if anything that's really going to support price, I think there's a scarcity of inventory. I mean, at this exact moment, we're at the bottom. We're at, we're at the lowest level of inventory at this moment in January since like 2016, 17. But that's going to change. This is the season where we're going to start to see things come on. I do think there's a handfuls of sellers that are still going to wait for that demand to push the prices before they start to come out in larger numbers, which may be fall, might be next year. But I do think that there's going to be movement. There's going to be there's going to be an increase in deal volume, which eventually will translate, like Jonathan said, eventually those closing prices will start to reflect higher prices.
And actually, if I could just add to that, Roberto. So when you think about like, are you optimistic about the market? And I'm talking to a bunch of real estate agents. What do they care about? They care about transaction volume.
Yeah.
And not prices. And I just said that sales are up. They're up across the boroughs. So when I look at that, I go, well, that's pretty optimistic.
Yeah.
When I talk about prices, I'm talking about prices flat. That's my 0. And prices are flat, but they're really, new development and higher end is up, and then resale activity is flat to declining in terms of price. I don't associate price trends with optimism or pessimism, because it depends on whether you're the seller or the buyer, right? It's all perspective. But transaction volume is what the market needs, and both in the US and in New York, for 3 years, sales have been sub long-term norms. And so sales activity is not going to be like, I'm not saying that sales activity is going to normalize this year. I'm saying it's going in that direction. And I think I say this every time I'm on your show, but like in 2023, I called it the year of disappointment. 2024 was the year of less disappointment, and 2025 is the year of getting back to zero. Is sort of getting back to par, parity. That's the goal. When you're looking about being optimistic, we're going in that direction. I don't know if we'll.
And that's going to feel good considering where we've immediately been.
Oh, absolutely. And when I think about like what, there's so many uncertainties sort of economically facing, consumers in 2025, all the changes being talked about or whatever. So there's a lot, but at least one thing is behind is the election. Like there's like that known, there's a known quantity now, and like that's actually, a 3 to 5% restraint on sales activity. And guess what? Sales rose in the fourth quarter 3%, a little over 3%.
Which to me speaks so loudly to the amount of demand that's actually there. Because
Totally agree.
It's superseded even that in an election like we just had, which was,
yeah, very polarizing.
Yeah.
And
so when buyers
so,
for the first time look over their left shoulder and right shoulder, and they're like, wow, there's a lot, these things are going fast. There's a lot of transactions, and I'm now in competition with this guy and this guy on this $2 million apartment. That drives what, the sentiment or the confidence, a rise in sentiment or confidence, whatever it does, it makes prices go up because
it's FOMO.
Once I see this guy and that guy are willing to pay more, I'm willing to pay more.
But that becomes FOMO. New York is notorious for, everybody waits until someone and then it just kind of goes. And then the next thing you know, you're like, what happened? There was no one in the marketplace. It's like, because you should have bought 3 months ago.
Yeah, I think of sentiment as more like overall economic outlook, what it sort of is gonna feel like, and confidence is more specific to like compensation and wages, and they're both up. So, the numbers have rebounded significantly since it's not at certainly record levels or anything close to it, but over the last year and a half, they've just been steadily rising, regardless of what's happening. And that whole period of rising confidence was happening at the same time rates are rising, right? So, I look at it as people were interrupted in early 22 with the Fed pivot, it's sort of peak frenzy, and their demand wasn't satiated. And so now we have this sort of, rising rates and sort of leveling off or certainly not falling significantly. And that doesn't, for people that can afford, we saw them buy, they saw them do something. The other point I wanted to make about inventory levels, I think I don't disagree with you, Roberto. Inventory is not like bloated, there's like tons of it. But I think the real issue with inventory, that like in the actual numbers themselves, they're not low. It's the fact that they're not accurately priced. So they don't feel like there's still a lot of product coming into the market that's priced like 2021 is my sort of take. And so what we're seeing is larger sort of listing discounts because the buyer is like rock solid. Like the mortgages are 7% now, not 3%, and I can't go any higher. Like they're much stronger in their refusal to sort of, counter an aggressive seller. And so we're seeing bigger listing discounts, especially in Manhattan. And I think it's because, it's the seller meeting the buyer more, traveling farther to meet the buyer. I guess that's probably the better way to say it. Because, it's like death and taxes. Like if someone in the same apartment line sold for $1 million and I'm the floor above, I want it 1,010,000, or 1.1 million, because I got to go higher, and yet the market is still 1 million. So that's the sort of the drag on transactions, I think, a little bit.
Jonathan, that's so interesting you mentioned that, because it's the same thing out here on the North Fork and the East End. What I did at the beginning of 24 was I took a lot of listings, and almost all of them I priced at the market where I felt the fair market value zone was. And they all sold within 3 weeks for at or above ask. And
Yeah.
everything else around it was still sitting.
Yeah.
It was kind of interesting to watch that dynamic.
Because the buyers are handcuffed, like they don't have, because if you look at mortgage lending, like banks are, I don't want to sort of stereotype and say more conservative, but they're not sort of ignorant of sort of the risks in the economy, and their underwriting is not like, hey, yeah, we no whatever, like
Right.
they're actually doing their job.
Yeah.
They didn't lose their mind in this cycle, which is encouraging, because that's why this is not going to be, it's not been as nearly as bad as it could have been, because we didn't have a collapse of the banking system like we did back 15 years ago.
Meredith
Although some
asked,
regional banks tried.
I mean, yes.
so Meredith asked earlier, if the California homeowners who lost their entire home and have insurance will take the check and walk away and move out of the state altogether. It really kind of asks, what have we learned from the Florida situation when we see one of these disasters or an insurance crisis generally? Is that a stimulus for people to move out and move into an area and new development?
No, it's not a stimulus to move out, at least that's what I've seen. Blanking out what the name of the big fire, not Paradise, the big fire in California, wiped the whole town off the map, and everybody's rebuilding. New construction, the prices are going to be higher because it's all new construction. First thing they did was put in, the schools and hospitals, and the services that make the community function. And
Were there insurance issues there, though? Did they get insurance money for the most part? Because now it
that's
might
my
be.
understanding.
And how long ago was that?
I don't know, like 10 years ago.
Yeah, it's a different market now. Very different.
Probably. Yeah, probably. But the idea is that or at least the way I think of it is, you will have people leave, but then people that have their whole family is in this area, whatever, are they really going to leave? Does everybody have the option to leave? I think it's
what I
kind
hear
of
you saying
easy.
I would think that, but
it's kind of
temporarily
easy.
you have to leave because it's unlivable, right?
Yes, temporarily,
So
correct.
for 2-3 years, probably even.
It's very, very possible. I mean, when Katrina hit New Orleans, 50% of the population moved to Texas and never
Did they
came
come
back.
back? How
No.
long did it take? It took 10 years, right?
I don't know. I mean, I
A little
know,
less,
no, they
probably.
moved out like with, immediately.
So what did that do to prices in New Orleans when
what the people that moved out were in the lower income demographics, in the low-lying areas that were prone to repeated flooding, and they just didn't come back. Certain districts, I can't remember the names.
The
I've
lower
been there.
sixth or something like.
Yeah, something like that. They're ghost towns. They're gone. And so the whole city restructured, basically cut everything in half. And I mean, not being intimately familiar, it appears to be functioning just fine. It just went through, a tremendous change. And there's going to be more Katrinas. I mean, that's, just inevitable. So those low-lying areas eventually aren't livable.
I want
Um,
to come back to that salt tax question as just evidence of. So we have a new president, and you mentioned that policy changes could be affecting. What kind, as a realtor or or as an owner of real estate, what kind of policy changes besides the salt tax changes should I be looking for as a harbinger of things to come? I mean, should I be worried about inflation rates? We heard about those. What
yeah.
the salt
So
tax?
so um, I think it's fair to say that you're not going to see mortgage rates drop significantly. I think it's also fair to say that you're going to see, inflation bump up from tariff trade policy. My guess is that's going to be short-lived because it's going to create domestic economic problems. Um,
I'll
uh,
name one. This week, Chinese bonds dropped a point to 1.6. Japanese bonds dropped to 2.2. US treasuries at the same time for the equivalent is a 4.6. So what I've heard is that there's going to be a lot of flow into the American bonds, and that's going to put pressure. It's going to put pressure on ours to drop. Yes?
it's certainly possible. When I think of the randomness of the policies that are going to come at us, um, it just makes it hard to forecast anything or to feel comfortable that you sense, that you have a sense of how this is going to play out. The only thing that I look at or think germane to homeowners at the moment is going to be probably mortgage rates, will probably drift lower by the end of the year, but they're not going to be that much lower than they are now. I see probably less exposure to taxes, next year and the year after, lower, whether or not there's a salt tax. I mean, that's the new administration, wants to bring those costs down. So more debt, which then fuels inflation. So there isn't like this panacea of economic policies that I think are going to really help the housing market. Yeah, I think it's just sort of going to move sideways, and you just have to put blinders on and not focus too much on the details. If that
But all indications
makes
are
any
that we got
sense.
a strong dollar, and
Yes.
it's getting stronger. So if I'm holding significant holdings in an international city like New York City or Miami, I'm feeling pretty good about foreign investment coming in. I'm feeling pretty good about a strong dollar. I might be holding my real estate assets, right? And in a
Yeah. I
period of
mean,
inflation,
well,
I don't care
well, when
about
I
the
think of,
rates.
I think of it just purely from a housing perspective. When the dollar is strong, housing is more expensive here to, say, for example, Europeans. And throughout my career, I've sort of like in the back of my mind,
Do they
and this
leave?
is no, they just don't buy, or as much, or think about this, like 10 years ago, that's probably 2007, 2008, so it's 15 years ago or so. When the euro, it was like $1.50 to the dollar. Like, a European could get a 50% basically discount buying in Manhattan, and they did like crazy. They bought condos sight unseen. It was huge. Now it's like 5 cents on the dollar, and so it's not enough to like trigger, um, you
A
know,
stimulus. Yep.
some sort of crazy surge in demand. Um, but tourism is, in the city is now back to record levels. Like it's not like the city is, all alone in the wilderness, but investors, while they're here, they're just here at more of a normal level rather than the supersized kind of volume we saw 10 or 15 years ago.
Let's talk, but what about, so from just thinking about investors, there are no investors that are looking to buy a property to rent it. The math just makes zero
It
sense.
doesn't work.
Yeah.
Right. Unless they're paying cash, maybe.
But not, I
Um,
mean, even that is tough.
yeah. No, I know. It's just, that's not the market now. It's
Yeah.
just really, it's really not the market. So, that's, you just know.
Hard to believe that too, with rental prices so high.
Yeah. But, one thing that I track, I track of what sells, I track maintenance and monthly maintenance for co-ops and condo and real estate taxes, combined for condos. And, I'm trying to remember. So for co-ops, the monthly, I'm gonna just round, I don't remember offhand, but it's like $1.50 per square foot per month. And 15 years ago, it was like 75 cents. And so the monthlies are much higher. Condos are higher than co-ops, because of new development and real estate taxes. So I think when you think about housing prices, it's really like, I think price growth is going to be moderated by the higher growth in
Expenses.
monthlies, insurance, and real estate property taxes. I think it's going to be the bigger issue than the cost of a house, would be my guess. I don't think the cost of houses are going to fall. I think that over the next 5-10 years, they're going to, probably flatten out. And then the economy is going to sort of catch up to them, as opposed to prices coming down and then stimulating. It's weird. And all this is because the Fed kept rates too low for too long during the pandemic and supercharged housing prices. And because that also chokes off, with the lock-in effect, chokes off inventory, prices don't normalize. They're going to stay elevated. There's not going to be a correction. So
Roberto, you want the last word? What'd you learn today?
Learned a lot. That was a really good final evaluation of really the next bit. I think that was amazing.
thank
Very
you.
good.
You think he's wrong about 0% price appreciation in New York City?
Boy, I damaged you. Like, I damaged you when I said that. Like, you are like,
And you tried
I
to
think
sell it like that's good news.
I think
I'm
whatever
being
increases we
optimistic.
have will be moderate. I don't know that it'll be zero, but
Yeah.
it won't be a lot. But I do think the activity will, it's a self-fulfilling prophecy. The activity is going to start, and then eventually we'll start to see it.
But the thing is that, I'm talking about New York City, and your orientation, you're thinking about like Fairfield County, and it's certainly, that's an area of price growth.
10%
there's
or
no
bust, baby. 10%.
Oh yeah, no, I totally agree, but that's not New York City. So
We should do an episode on Connecticut
sure.
before all the getting's gone. I want to express sincere gratitude to my guests, Jonathan Miller and Scott Bennett on the North Fork of Long Island. Thank you very much for weighing in.
Thank you for welcoming me on the call, and it was great to hear from all of you. And thank you, Jonathan.
Yeah, thank you, Scott. Appreciate it.
Thank you,
so much,
Meredith, for
guys.
reminding us about insurance and all the scary things that's on everybody's mind this week in California. Thank you, Meredith, for joining us. If you love real estate like we do, tell all your friends, give us a review, hit share, hit like, check us out on YouTube. Thank you all. It's been a great show.
Thanks
Thanks,
so
guys.
much.
Thanks, guys. Nice seeing everybody.
Great seeing you.